Hi, everyone. It's Joe Gordon with Gordon Asset Management. Today's Tuesday, July the 21st, and today is it's noon, and it's time for our weekly market update. As always, we have our disclosures in here. These are opinions from third-party sources, and we're just trying to put a lot of good information together to help everyone have an idea what's going on as it relates to your wealth and your money, and we're not giving any investment advice or tax or any other kind of advice in this presentation. You can follow us on YouTube, just youtube.com and search Gordon Asset Management, and you can see all of the weekly updates, or you can sign up on wealthqb.com and watch any replays at your leisure on YouTube too, which is nice. So let's see what's going on. Here's your typical opening slide on the coronavirus update, because it seems to be driving the economy and the stock market somewhat. And you can see here the purple line, 3.81 million cases in the U.S. You can see hospitalizations down here in the blue line, COVID deaths, 133,000 and trending. And then also the death rate, which is really probably the most important slide at 3.49%. So whereas the U.S. has the most cases, we have, I think, the third most people on the planet behind China and India, but the death rate's extremely low. If you look at global confirmed cases, daily increase in this graph, you can see the big problem is Latin America, but the big problem is also North America, which includes Canada and so forth, whereas other economies that really more shut down, Southeast Asia down here is increasing a good bit, but you see Europe in general has been closed and so forth. Daily increase in fatalities, basically you can see here Europe's got a huge decrease here, and then you've got North America, which we were way down, but it's spiking down a little bit up here on an uptick. So not good news, but we did open up all the economies pretty much in the state, and in most states, many of the Republican governor states for at least, but now some are partially shutting down, as everyone knows from the news. So let's look at stock markets. Through yesterday, developed markets, Europe, Asia, Far East, are down still almost 9% year to date, and that's graphed here in the purple. And you can see emerging markets, they are rebounding. You can see it is both Europe, both EP and EM are trending to the northeast, which is positive and definitely way off their bottom. Global aggregate bond index is positive. That's really been where people put their money for safety. In the U.S., it would be intermediate bonds in the U.S. and treasuries. So basically, things were fairly steady last week. U.S. market, a lot going on. As you can see here through yesterday, the S&P is now positive for the year, which is kind of crazy given what's gone on. We have a great slide to illustrate that effect at the end today. And then you can see what's really been running. NASDAQ, which is mainly your technology and biotech type of stocks, healthcare, up 22% year to date. It's hard to believe it. But when you look at NASDAQ, which is the orange bubble, you can see back in March, many of these stocks in that index were down 40 and 50%, but they've all pretty much rebounded, and here we are. But still, to be a rally, usually small caps always lead out of a recession. Russell 2000 is still down 12% year to date, and the Barclays Aggregate Bond Index is up 7. So if you've been in fixed income, where we've had a lot of clients on the sidelines in this, you've done fine, but it's not as exciting as the rebound off the bottom in technology for sure. Again, we've seen this chart before, and we looked at it last week, and it's just updated. I'm going to contrast here the financial crisis, peak to trough, down 49, and in 2008 alone, down 38%, and then we were down 34% in about 1 month, from mid-February to mid-March or so this year, and now +1, which is just kind of crazy. That never happens. So returns by sector, and again, we're now in the third quarter. So when we look at quarter-to-date data, you can see here, going over the middle, technology and communication services, which is formerly some tech companies and so forth. You can see Year-to-date, technology up 20, communication services up 7. That's been where the action is. In contrast, utilities down year-to-date. We expect them to continue to do well going forward in the zero interest rate economy because of their sustained dividends. And then you look at consumer discretionary up 16% year-to-date. And then to the far left, financials, it's improving, but still down 21% year-to-date. And a little pop this quarter. And energy, consistently the laggard, down 38% year-to-date, and so forth. So we looked at this, and quickly you can see year-to-date large growth is stomping large value. That's not any different. It's just starting to get even more extreme. And you can see it in mid caps and small caps. It is winning big by not losing as much. Small value's been the worst place. And a lot of those kind of companies are small financials, like think community banks and so forth. And so they've been really, really hurt. So really year-to-date, that's the story. And you can see off the market lows of 09 in this secular bull market, growth has doubled what value has done, basically. So S&P valuation measures, again, I always caveat this. We are greater than a 1 standard deviation event for the index. But remember now about 21% of the index is 5 megatech companies. And I saw a recent data point today or yesterday that talked about the top 10 companies in the S&P index, which are mainly tech. They really all trade at 30 times earnings or more, which is what's floating this up. About 490 stocks in the S&P 500 are not trading anything more than the normal 16 times, 16, 17 times. So again, we'll keep our eye on this, but it's just worth mentioning that the index PE is being pulled way up by just a small handful of stocks. This is one of my favorite slides, looking at it, because what it really tells you about is the activity as the economies have tried to open up. So you see purchase mortgage applications definitely up 16%, but diners at the bottom were down 100%, now only down 60%. Travelers, TSA was down, traffic down 96%, now down still 73. Driving down 47, up 38. Global flights still very negative, minus 18, because basically a lot of travel, international travel, shut down. Even U.S. passengers cannot go to the Bahamas. I believe that was the one announced yesterday. And hotels the same, down 69%, only down 38, but they really need to be a lot better than that. The occupancy's got to be pushing 65, 70% for anyone to make money in both flying and hotels, etc. So you can see here, each one of them graphed, and clearly the restaurant, seated diners, been the most jagged one, and will continue to be so as economies pause or partially shut down or whatever. Everybody's all over the map. Now you look at this, it's all graphed here. You can see mobility in developed market countries. You can see how everything fell off a cliff, and when we went to the shutdown economy back in March, April, May for the most part, and then things gradually opening up, but still below the norm. And in EM countries is kind of the same, but you can see certain countries are still very vastly different than others, with South Korea being probably the best example in EM, or developed emerging markets. So now in the U.S., what's going on with unemployment? As you can see here, people in continuous claims is down to 17 million from a peak of almost 25 million. And you can see that the claims have peaked, weekly claims have peaked, and it's going on a downtrend. And that's good news. But there again, there are a lot of companies that have announced they're going to be laying people off, furloughing permanently if they don't get more bailout from the Fed or Treasury. Job postings are falling, which is concerning, but just shows you some jobs are not coming back. And also with the rapid move to working from home, remotely, Zoom video, GoToWebinar video, etc., that maybe a lot of companies decided they don't need as many people, and I think that is the case. but also probably growth is going to be constrained. So you can see here lower job postings. That's not a good sign. Unemployment and wages. 50. The funny thing is that we're having wage growth in a recession. I guess that's the summary point here, which doesn't make any sense unless you factor in the $600 per week extra federal unemployment check. A lot of people have more spendable income at the lower range of incomes, workers, than they did when they were working. So that's obviously a problem. And so that's the debate going on this week in the House and the Senate and the Treasury with Mnuchin, Pelosi, and I guess the Senate leadership is to are we going to extend the 600 after it expires the end of this month? And if so, is it 600? Because that creates a perverse incentive for people not to work. Or is it going to be some iteration of that, 300 extra dollars, which would be like a stimulus check of 1,200 if you got 300 a week federal on top of state. Anyway, economic growth and GDP composition, you see here still the consumers 68% of the action, government spending 18%, and so forth. And you can look here in the financial crisis, GDP change year over year, and so forth. And then you can look at it here, but quarter over quarter change, we're down 5%. And the real issue is Q3 going to make a difference? We'll see. Consumer finances, consumers still in very good shape. The trend is good at the bottom right in household net worth over time. The consumer owes less debt as a percentage of disposable income than in the financial crisis, which is good, about 40% less. And you can see the composition of net worth of the average consumer, which again, other financial assets, retirement funds, some cash deposits, and homes make up 27%, a significant part. The biggest thing, or one of the big things about the unemployment data is educational attainment. There's a huge correlation between your income, advanced degree, and earnings. And you can see here, if you have a high school graduate, your average annual earnings by highest degree earned for someone 18 and older are significantly less than someone with just a college degree in the middle, 71,000, then advanced degree or postgraduate degree. And then over here on the left, unemployment rate by educational level, you can see clearly in the last financial crisis, it really hit those that did not have any degrees the hardest, and it even has hit them the hardest here at between 21% for those with less than a high school degree. Income inequality in the U.S., this is a big political debate you hear in the press all the time in an election year. And here you see that the top 10% of pre-tax income, 50%, 51% almost, goes to the top 10% earners. And then when you look at what the spending patterns are, the bottom 90% spend 101% of their income after tax, and that's because some of them go into credit card debt, whereas people that make more tend to save some, and that's the 69% data. So we looked at that last week. Inflation is not an issue. I hear everyone worrying about it because of all this money printing and so forth. But I will tell you, if you want to look at one country as an example of no inflation, look at the last 30 plus years in Japan. We are on the same track now, but at an accelerated pace. So there won't be any inflation at all unless we continue to money print to the sky. At some point, something's got to give. The Fed and interest rates. So you can see here the interest rates. Basically they're zero bound, and there's not much expectation there's going to be anything but that for the foreseeable future. So that's good news. That's why mortgage refis and mortgages in general and home purchases are at an all-time high. Yield curve. So the last time we went normal after the 08 financial crisis, you can see interest rates in 2013, 5 years later. And, the 30-year was up just under 4%, the 20-year 3.72%, the 10-year around 3%. We were around 3.25% in November of 2018 when the new Fed chairman was hiking rates. LB Dan because he wanted to normalize things until he threw the stock market into a tizzy in the fourth quarter of 18 and then lowered rates 3 times in 19, which created a huge 30% return in the market. But you can see here, we're way, way off. I mean, we're 1/5 on the 10-year of where we were in a normal recovery, and the 10-year at 0.62 and the 30-year at 1.32, which is 1/3 of what the normal recovery is. So yield curve very, very different. Fed balance sheets expanding. You can see down here 20, the line where we are to 20, and essentially various things, but treasuries, a lot more treasuries, mortgage backs, et cetera, loans and other, but definitely the Fed balance sheet way, way bigger than any time in history, even the wars that were followed World War II. Global monetary policy, it's all the same. I mean, everybody's liquidating or liquefying their economies, and you can see here the Fed is the dark gray graph, the blue is the ECB, and then you've got Bank of Japan, and then you've got Bank of England, since England's pulling out of the European Union. And so obviously, when you look at rate changes by EM, emerging markets, and developing markets, cuts versus hikes, there's been a significant higher probability you're going to see cuts to try to get economies going again out of this COVID-19 pandemic. Global fiscal support. There's a lot of spending going on. You see the United States, though, we're doing a lot more spending, but also a lot of loans and equity and other guarantees to support industries most affected, think airlines and so forth. But then versus other countries, Germany, lots of loan guarantees and loans at 31% increase, and Italy 34%. So really everybody's kind of doing their own iteration of it. We're not alone. So one of the things everybody keeps asking is, why is the stock market going up when things aren't all that good? And this is what's becoming more discussed as NASDAQ's hitting all-time highs and so forth, and now that the S&P is positive for the year. But it's all the money printing. It is the liquefaction of the economy, which is making stocks bubble up. It's really that simple. It hasn't been done to this amount. Now, here's one of my favorite slides today as we get near the end. So if you contrast NASDAQ January 20th versus July 20th, you can see up 15%. If you do GDP year-over-year growth rate, you can see, well, we were trending at 4 in January, but now we're -7. Okay, so how does that mean the market, NASDAQ, is up when that's not good? Unemployment is almost 4 times or 3 times worse than it was. The unemployment rate, continuing claims, 17 million more, or 16.3 million increase. Debt to GDP ratio, and this is what's going to impact interest rates long term, is the old Adam Smith saying, debt is future consumption denied. You rob growth from the future, and so you go Japan-like for decades. But the GDP ratio is way above the 100% level that many economists say is a really bad warning sign. So we're at 123, and it'll probably be going up. So Fed funds rates at 0, the 10-year already mentioned, and so forth. And then you look at earnings estimates. They've come way, way down, and they're expected to rebound, though, in 2021. We'll see. But when you look at all this data, you have to ask yourself, how in the heck is the stock market doing so well when the data looks so bad? And again, think Fed, think Treasury, injection, liquidity. Looking at global returns real quickly, over on the left, a 15-year plot of, you got U.S. at the bottom, 9% a year for 15 years, emerging markets, 7.8, so it's not a bad place to be sometimes, just not been any good the last 8 to 10 years, more or less. And then you see Europe, ex-UK, just under 6%, and Japan, 4.3%. So that's long-term performance. And then you come to the far right, and you look at 2020, current from the trough. You can see basically earnings multiples have expanded like mad in Europe to drive up stocks, same in the U.S., while earnings are through the floor. And again, that's that whole question: how can earnings be so bad and multiples be expanding? And again, think liquidity. At inflection points, again, this is more data. If you look at the all-country world index, ex-US, and look at average PEs, you can see things are not that overpriced outside the US. We've looked at the graph another way. You can see, well, things are way up here in the US with expanding PEs, again, led by megatech. So valuations, more of the same. Global valuations are not bad. That's why you're going to see a lot of data you may read, whether on the internet or papers or TV here, is going to be talking about valuations in emerging markets, and ex-US are sensible, and that's where the future best returns are going to be. But I'm not so sure, because there's so much tech disruption, biotech innovation going on. I think the US is still going to get its share. Asset class returns, again, year to date, safety, fixed income up 7%. That's a great year. A lot of people have been complaining, well, what is the 60-40? How's the 40 in bonds going to make any money? Well, it's pulling its weight this year. Whereas the U.S. stock market, we mentioned earlier, is up about 1% now year to date, less large cap here. And then cash, you're not earning much on cash, but you're not losing money. And then if you look at credit, it's down, but it's recovered a lot. Emerging market equity is starting to recover a lot. And developed market equity still down 7 to 8%. Small caps U.S. still down 11 to 12%. REITs, I would look for recovery with the dividends, but I would avoid any REITs that have anything to do with malls per se. And then commodities are actually starting to rebound off the bottom. Gold's reaching at its all-time high that it last met in September of 2011 as it pushes towards $1,900 an ounce, and silver starting to break out, and copper is, which shows there's a recovery going on. We looked at this last time, and again, it's time, diversification, and volatility. Still, stocks are the riskiest thing to be in short term and with a 1-year horizon. You can lose a lot of money if your timing's not good. You can also make a lot of money. If you put all your money in March 24th, you think you're really intelligent right now, like the founder of Barstools. So, but still, over long periods of time, you do get rewarded for being in stocks, and the volatility does tend to go down. So that's it for today. We've got a lot of good data, and again, we'll keep you updated. There is a lot coming out. Next week ought to be real interesting to see what does get done in Congress, if anything, this week. And I think there is a joint goal to please and give more stimulus in the way of the federal unemployment, but also I know the Republicans want a payroll tax holiday for American workers as well. So we'll see what gives up there, but either way, they're going to be spending your money, and the real question is, who's going to pay for all this someday? That's really the $64,000 question. Thanks for your attendance. Look forward to any input, emails. You know how to contact us, either info@wealthqb here, or you can call us, or if you have our individual email addresses, reach directly to any of us. Thanks, and have a good day.